Have we finally reached the economic tipping point in the economy? Are we finally getting some signals from the bond market that are telling us the equity markets are pricing in a bit of downside volatility and potentially a macroeconomic slowdown? Now, before all of the macro bears jump out and call for an epic crash, we have to really take things slowly and kind of week by week during this next phase of the market. And that being said, this data can absolutely change from week to week. But obviously, on the back of Friday, we saw an epic down move in the yield market. Two-year yield closing down 7% on the session. That is a massive, massive move to the downside. It has been a while since we've seen such crazy volatility in the interest rate market. The downside candle came on the back of a lower than expected non-farm payrolls print, obviously showing a little bit of potential weakness in the US economy, and therefore you're seeing a massive decline in the equity markets as well as the bond market. We could be potentially entering something called a bull steepening phase. What does that mean? That is a term you're likely going to hear over the coming weeks across the finance community, online videos, but a bull steepening is when you have the short-term yields, which is this two-year yield, falling much larger than the long end of the yield. So obviously taking a look, this two-year yield was down 7% on the session. When you look at the US 10-year yield, although this is a pretty nasty candle to the downside, it was only down 3.79% on the session. So what does that mean? When you have a divergence between the short end of the curve and the long end of the curve, investors could be potentially pricing in an economic global slowdown, aka the R word that no one likes to use, a recession.